Welcome to Quantum Finance. My name is Parker. I'm the head trader here, and today I wanted to make a quick video breaking down the Bollinger Band indicator. The Bollinger Bands here, as you can see, these dashed lines on my chart are a representation of two standard deviations from the mean. And typically most people use a 20 simple moving average here as the mean price on the chart. So the standard deviations here are a good way to identify resistance and support on charts. Typically, if the stock is running into the upper band, that's a sign of being overbought. If it's running into the lower band, that's a sign of being oversold. But currently here we are on the 5-minute chart, and we're just through this video we're going to work our way up through the time frames because it does really differ how they're used here. So starting on the 5-minute, it's mainly used for like squeezes, right? If y'all have seen my squeeze video, you understand what I'm talking about here. But as you can see on the Bollinger Bands, it goes through these periods of getting like really tight and then just massive expansions, right? And those are your squeezes, right? When you have the volatility compressions and then you have your volatility expansions. So on the 5-minute, it's mainly used for identifying trading opportunities, right? To identify when the price is compressed the most before a large move happens, right? That's the squeeze. But we're not going to cover that too in detail here because I have a whole video on that. So now we'll work our way up to the 15-minute time frame. And the higher time frames, the more significant the Bollinger Bands are going to be because it is taking in a lot more data. So on the higher time frames, it's really good for being used as identifying support and resistance targets. So as you can see here, for example, we run up into the upper band, find resistance here, pull back into the lower band, right? Then just the same thing, running into the upper band, resistance, running into the lower band, support. And I mean, and here, for example, we are extremely outside of the band, which in data terms is an anomaly here. So there's an extremely high probability that this will pull back inside the band, right? Just because that's how statistics works, right? You can't have too much, expansions because there's always will be a mean reversion. So as you can see here, we can just kind of go through the chart. As you can see, running into the upper band is typically a sign of resistance and the lower band as a sign of support, right? And obviously this is only the 15-minute time frame, so there is a lot of outliers here, but you can see the significance, right? How the price just kind of stays within the bands, right? It will go outside of it, but if it's outside of it, it will revert back to the mean extremely quickly, as you can see. So now we'll look at we can go to the 1-hour chart here. So now we're getting into the higher time frames where it becomes extremely significant when, the support and resistance levels, and becomes much more obvious how price moves between the upper and lower extremes. So as you can see, like just running into the upper extreme here, going down to the lower extreme, right? As you can see how the price just pretty much just moves and bounces in between these bands, right? I'm just going to kind of scan through here so you can see what I'm talking about. Just give y'all a good idea on how Bollinger Bands work, right? As you can see, the price just bouncing and moving in between these bands. So a really useful tool to identify, like, say you're in this trade here, right? Say you identify this kind of falling wedge pattern here, and you think this is a bullish reversal pattern. So you see it. This is a bullish reversal pattern running into the lower extreme here, which is support, a sign of being oversold. And if you bought here on this breakout, right, a good place to take profit would be up here when it's running into the upper extreme, when it's running into this upper band, because that means it has reached two standard deviations to the upside beyond the average price. So that is why it's a really good tool to use for identifying sell targets. Because as you can see, we ran into this upper band here before really rolling back over. Here's a squeeze here, and then really rolling down, right? So just as you can see, the consistency in it Now we can zoom out a little more. We can go to the daily chart. So as you can see here, the daily chart, the same thing. Price will, sorry, let me delete this real quick. You see how the price runs into it as resistance and then falls back into it as support? You see that? Very useful tool to use. So when investing, right, I mean, you can see at the chart, basically when, not for day trading, but for like pure investing, the better investments, the classic buy low, sell high, that low is typically going to be the lower standard deviation, right? You want to buy when price is extended well beyond the mean to the downside. And you want to sell when the price is up here into the upper extreme on the upside. But this is the daily chart here. This is more of just a range bound kind of thing. The higher time frames that we're going to get into here in a minute are better for more long-term investing. I just wanted to give you examples of how the Bollinger Bands work and how the price moves in between them at each time frame. So as you can see here, this was the 2020 election, and all the way up until the high we got last year, you can see how the price in the stock market just bounce up and down between these Bollinger Bands here to work its way up through this uptrend, right? But now we can get to more like towards like long-term investing when we start getting out to like the weeklies and the monthly Bollinger Bands. So for like longer term investing, if you're trying to identify like good spots to buy, historically speaking, when the price is below or at the lower extreme here, the lower Bollinger Band, has typically been a pretty good time to buy, right? So as you see down here, the price went out and got down to it, would have been a decent spot to buy. Here, if you were buying or just like slowly dollar cost averaging as price is reaching these lower extremes, I mean, obviously like in here, you're still down, but you're not that far away from being positive, right? And this is buying here like before a whole year of downtrending, right? But as you can see back here in the COVID crash, as you see the price really extending down through this lower extreme here, this would have been a really nice time to, accumulate assets, right? Because you're buying on a large time frame here. We're looking at the weekly chart, which is this is years of data, right? Going into these bands, right? So as you can see back here during 2019, the price got down through it, right? Would have been a great time to invest, even here, right? I mean, some of these, like if you're buying here, you're gonna have to wait a while. But I mean, we're talking long-term investing here. We're not talking day trading at this point. But I mean, you can go back throughout, the past, couple decades, and you can see on the weekly chart when price has peaked, gone below these lower extremes, or even touched them. That has typically been a really nice sign to accumulate or dollar cost average into your assets. And then we can even zoom out a little more here to the monthly chart so you can see the significance here in the monthly chart. Hold on one second. Let me max this out. So you see on COVID, right? We pierced down through that monthly extreme. Would have been an amazing investment opportunity, right? In October, we pierced down below it here. Would have been an amazing investment opportunity, right? 2019, pulling down into it. Amazing investment opportunity, right? 2016, right? 2015. As you can see, whenever we're, even like during 2008, right? I mean, you would have, this is a longer term hold, but if you're buying as the price is down below this monthly Bollinger Band, I mean, in the long term, look how you did, right? Like even during 2001, like if you're buying here, you're buying here, and you're buying here below these monthly extremes, within a couple years, right, you're looking nice. I mean, obviously, I was kind of too young for all this, so I'm not the best to talk about this time in history with like 2001 to 2008 happened. I didn't really even graduate college till in here, so it's been a while. I didn't really have firsthand experience with this, but I have firsthand experience with pretty much all of this. So, yeah, I just wanted to say that for full transparency here. But as you can see here, recently October would have been an amazing long-term investment, um, because we were below this lower extreme here on the monthly chart. So yeah, that's pretty much most of the time frames covered. At the lower time frames, like the 5 and 15 minute, they're really good for identifying like squeezes. And for the higher time frames, like the 1 hour, the 2 hour, they're really good for identifying resistance for day trades, like sell targets. And then when you start getting up into the daily, weekly, monthly, that's when they start becoming really useful tools for longer term investing, right? So yeah, that should do it for the video. Hope y'all liked it. Appreciate y'all watching, and I will talk to y'all later.